One of the decisions managers of firms need to make is how to finance the acquisition of additional assets. Typically, we'll finance additional assets by issuing bonds payable or notes payable or bank loans. In other words, we'll have an increase in our liabilities. Or a firm can issue additional equity claims. But in making this decision, one thing that managers typically want to do is we want to try to attempt to match the maturity of our new assets with the maturity of our liabilities and equity. When we acquire assets, we do so with the anticipation they're going to generate cash flows in the future. And if those cash flows are going to occur over a short-term time horizon, we'll typically want to finance those assets with short-term liabilities. And if they're going to be longer-term cash flows, we'll want to finance those with longer-term liabilities or perhaps equity. Our goal is to try to optimize our short-term liquidity, in other words, our ability to meet our short-term financial obligations when they come due, and also maintain an adequate level of solvency, which is our longer-term ability to meet our financial obligations. Let's go ahead and look a little bit further at this concept of trying to match the maturity of our assets with the maturity of our liabilities and equities. For instance, if a firm were to acquire additional inventory or build up its accounts receivable, both of these assets are going to require financing. Typically, we're going to want to try to finance these short-term or current assets. Recall, a current asset is an asset that we expect to convert into cash within 1 year or operating cycle, whichever is less. And clearly, we'll expect to sell our inventory within the next year and also collect on our receivables. Well, we want to match these with liabilities of a similar maturity. We'll typically try to finance our inventories and receivables using short-term debt, accounts payable, which is our trade credit. We buy our inventory typically on account, or perhaps with short-term notes. But again, the idea is that our assets will be generating cash over the next year, so we can fund them with liabilities that will be satisfied with that cash also over the next year. On the other hand, if we were to acquire longer-term fixed assets, such as plant and equipment, we're going to generate cash flows over, say, a 5, 10, or 15-year period. And we wouldn't want the full amount of the liabilities that we finance those assets with to be due in the coming year. So instead of using short-term liabilities, we'll use longer-term debt or perhaps issue long-term bonds. And again, our asset will generate cash flow over a long period of time. So we want to make sure that the liabilities that we have to pay are also scheduled over a longer period of time. We might even also finance these longer-term assets with additional common stock or preferred stock, as those really don't have a maturity at all. We may pay dividends on our common stock and typically do pay dividends on our preferred stock. But again, those are cash flows that are spread out over a period of time, which matches the cash flows likely to be generated by additional investments in plant and equipment. We're now going to look at activities 1 and 2, which examine the short-term ability of a firm to meet its financial obligations, its liquidity, and activity 2, which looks at its longer-term ability or its solvency. The current ratio helps us assess a firm's short-term liquidity. It compares a firm's current assets to its current liabilities. And as a review, let's go ahead and take a look at some typical current assets. Our most liquid current asset is cash. Then also additional current assets would include things such as accounts receivable or inventory or other prepaid expenses. Current assets, recall, are obligations or assets that we expect to convert to cash within 1 year or one operating cycle, whichever is shorter. Current liabilities are financial obligations that we're going to need to satisfy or pay within the next year or operating cycle. And those will include accounts payable, accrued expenses, things such as wages payable, utilities payable, taxes payable, or interest payable, and also maybe perhaps short-term borrowings, which we often refer to as notes payable. Our current ratio then is the ratio of current assets to current liabilities. So for Walmart, to calculate the current ratio, we'll take our current assets of $59 billion and divide it by $71 billion in current liabilities. And we see Walmart has 83 cents in current assets for every $1 in current liabilities. Boeing has $57 billion in current assets compared to $44 billion in current liabilities, or a current ratio of 1.27. In other words, it has $1.27 in current assets for every dollar it has in current liabilities. Harley-Davidson has $2.70 in current assets for every dollar in liabilities, and Apple is at 1.68. In terms of our current ratio, the firm that appears to have the greatest short-term liquidity would be Harley-Davidson, with a current ratio of 2.7 to 1. Generally, an increasing trend in our current ratio, or an increasing current ratio, is considered to be favorable, or it shows higher levels of liquidity. And all else being the same, a decreasing trend is generally considered unfavorable. If our current liabilities are usually paid off with our current assets, which corporation would be unable to pay off its current liabilities at this point in time? And that would be Walmart. But that certainly doesn't mean that the company is insolvent or unable to pay its bills, because one, current liabilities are those that are due within the coming year, not necessarily today or tomorrow, but within the coming year. And Walmart's likely to generate additional cash within the next year. Also, current liabilities can include borrowings under, say, revolving lines of credit, which may be renewed at the option of the borrower in conjunction with that of the lender. And third, the company might have access to other funds under a line of credit, which is much like a credit card, or might generate cash from asset sales, or have some other source of cash coming in. So it's important to remember that a current ratio of under 1 doesn't mean a company is unable to pay its bills, but all else being equal, we would prefer a higher current ratio in terms of a liquidity perspective. Finally, though, it's important to keep in mind that it is possible for a firm to be too liquid. The reason for that is liquid assets don't offer much in the way of a return for a firm and can actually hurt its profitability. Current assets such as cash, accounts receivable, and inventory don't offer much in the way of a return. In fact, inventory involves carrying costs such as storage, insurance, and the risk of obsolescence. Instead, a firm can earn much higher returns by investing its capital in additional plant and equipment or opening additional stores. We can earn higher returns and thus improve our profitability. And finally, not all of our current liabilities have an interest cost associated with them. Accounts payable and accrued expenses are non-interest bearing, and they provide a cheap source of finance. In fact, they're often referred to as a free source of capital. Let's go ahead now and take a look at a firm's longer-term solvency, which we said was its ability to meet its longer-term financial obligations. And we'll do that by looking at activity number 2. The debt ratio is a measure of a firm's long-term solvency and the portion of assets that are financed by debt. It compares total liabilities to total assets. We could also look, instead of the debt ratio, a very similar ratio would be the debt-to-equity ratio or the asset-to-equity ratio. And we can see from our accounting equation that all of these essentially give us the same information, different numbers, but the same information. How much of our assets did we finance with debt versus how much did we finance with equity? In terms of Walmart, Boeing, and Harley-Davidson, and Apple, let's go ahead and calculate the amount of equity for each corporation. For Walmart, the total equity is $76 billion. That's the $203 billion in total assets, minus the $126 billion in total liabilities. Boeing has $5.8 billion in total equity. Harley-Davidson has $2.5 billion, and Apple has $123 billion in total equity. In looking at these ratios, it appears as though Harley-Davidson has the lowest amount of equity and Apple has the highest amount of equity. But again, that's in absolute dollar amounts. We want to compare the amount of debt or equity we have to the amount of assets, and that's what our debt ratio does. The debt ratio for the Walmart Corporation is 0.62. We calculate that by taking the $126 billion in liabilities divided by $203 billion in assets. So Walmart is financing every dollar with assets with 62 cents in debt and 38 cents in equity. Boeing has 93 cents in debt for every dollar in assets, which means it's only using 7 cents in equity. Harley-Davidson's debt ratio is 0.72 dollars in debt for every dollar in assets, and Apple is at 40 cents in debt for every dollar in assets. In terms of percentages, we can see that with a 0.62 debt ratio, Walmart is financing 62% of its assets with debt, and again we said then the other 38% would be equity. For Boeing, what percentage of their assets are financed with equity? With a debt ratio of 0.93, that means 93% are financed with debt, and the remaining 7% are financed with equity. A company financed heavily with debt will tend to have a debt ratio greater than 50%, while of course a company financed with lower levels of debt will have a debt ratio less than 50%. In terms of the four companies we're looking at, the companies that rely most heavily on debt are Boeing, 93 cents of every dollar is financed with debt, and then Harley-Davidson that uses 72 cents in debt for every dollar in assets. If the debt ratio measures the amount of financial risk that a firm has, the company with the greatest amount of financial risk would be the Boeing company. And in general, companies that have higher financial risk are required to pay higher rates of interest, which helps explain why firms that have greater amounts of debt tend to be higher financial risks, because unlike dividends on equity, interest expense on debt must be paid, as must the principal upon maturity. Therefore, a company that takes on more debt increases its risk of financial distress, default, or perhaps even bankruptcy. Now finally, does a high debt ratio indicate a weak corporation? And the answer to that question is no. A high debt ratio by itself doesn't mean a company's weak. We need to look at other factors, including a company's profitability, its efficiency, its liquidity, and cash flows. Debt ratios will vary for companies over time and also vary greatly by industry.